Hi everyone, I'm Sumaira Abidi and you're watching our Made for YouTube series where we try to understand different concepts related to mutual funds. Now, month after month, we've been seeing increasing amounts of money flowing into hybrid funds. Now, hybrid funds are basically the bridge between equity and debt, and hence the name hybrid. And it is this combination which has become quite appealing to both equity and debt investors. At 4.6 lakh crores, the hybrid category now accounts for about 11-12% of the Indian mutual fund industry. But did you know there are 6 types of hybrid funds? The first is called the conservative hybrid fund, which essentially has a much higher component of debt at 75 to 90% and only 10 to 25% allocation is given to equity. And as the name suggests, it is meant for those investors who are quite risk averse and prefer the safety of being in debt. Now, the second set actually has 2 options, right? So the first one is the balanced hybrid fund, which is sort of an equal weight allocation between debt and equity, though to be technically correct, the allocation for each should actually be ranging between 40 to 60%, right? The other option in this second category is the aggressive hybrid fund, which, as its name suggests, is quite overweight equities. It's very aggressive with a 65 to 80% allocation to equity, and the balance 20 to 35 is given to debt. And get this, SEBI says that an AMC can either offer the balanced hybrid fund or the aggressive hybrid fund, but not both. And this balanced hybrid fund should also not be confused with what we call the balanced advantage fund, which is another category and actually now one of the most popular categories in the hybrid space. So the balanced advantage fund can also be referred to as the dynamic asset allocation fund. And the key here is that there is no set or predefined or mandated allocation either to equity or to debt. It's the fund manager who has the discretion to take this call, and that's why the name dynamic, right? They're also called BAF. If you're speaking to someone and you hear the name BAF, it's short for Balanced Advantage Fund. So don't get confused. Now we're halfway through. We've done 3 categories. The fourth is called the multi-asset allocation fund. And finally, investors have more choices than just equity or debt, because here the definition says that the fund must have a minimum of 3 asset classes. You can have more, of course. The most popular combination here is, equity, debt, gold as well. The fund must invest a minimum of 10% in each of the asset classes. The fifth is the arbitrage fund, which is, also quite a popular option. It's about 1/4 the size of the hybrid category. Here, what is arbitrage? Well, the fund must own a minimum of 65% in equity, which follows the arbitrage strategy, right? So the question is, what is arbitrage? Well, arbitrage is the leverage of the price differential in different markets. Most likely, it's cash and derivatives, and the difference is what generates the returns, right? So let me bring in a very simple example just to illustrate this concept of arbitrage. Is a fund manager buys a share in the cash market for, say, 100 rupees. Simultaneously, he's selling it in the derivatives market for 110 rupees. So the 10 rupees difference is the arbitrage profit which has been generated. Now, this is just a very basic example. The reality is a little bit more complex, but you get the drift, right? Arbitrage funds are also considered to be quite low risk. In fact, many of them follow the benchmark of the liquid fund too. But arbitrage opportunities may not always be there, and they may not always be profitable. Just in the last year, we have seen 2 to 3 instances of negative arbitrage, but this is not very common. And besides equity, where you have minimum 65% allocation to equity, the rest of the money can go into debt, and mostly this is, very high quality debt that they invest in. So this strategy actually works best in a volatile market, and as with everything else, make sure you understand what you're getting into and why. And finally, the 6th category is the equity savings fund, which invests a minimum of 65% in equity, a minimum of 10% in debt, and they can use a pre-decided level of arbitrage as well, right? So this arbitrage is what sets this fund apart from, say, an aggressive hybrid fund, which can also have 65% in equity, because the arbitrage portion can provide downside protection and therefore helps to reduce the risk in the fund. But, like I just said, investors must remember that returns are linked to arbitrage opportunities, which may not always be there. So I hope this clarifies all your queries on hybrid funds and their varieties. If you have any questions or comments, do write in to us. Thanks very much for watching. Stay safe.